$10 billion. Not his. Borrowed. And he's about to bet every single cent of it against one of the most powerful banks on the planet. Lose, and he's finished. Win, and he makes more money in one single day than most companies make in 10 years. This isn't a movie pitch. This is exactly what George Soros did on September 16, 1992. By the end of that day, he was up over $1 billion. The Bank of England had already lost billions trying to stop him, and by dinner time, he already had a nickname that stuck forever: the man who broke the Bank of England. It wasn't luck. He didn't have secret information. A government made a promise it couldn't actually keep, and one guy was willing to bet everything on the fact that everyone could already see the promise was broken. So let's go back to where this all started. 1990. Britain joined something called the ERM, the exchange rate mechanism. European countries agreed to keep their currencies trading within a tight, locked range against each other, getting ready for one shared currency down the line. Britain locked the pound to the German mark at a fixed price. Locked meant locked. The Bank of England was telling the entire world, we will defend this exact price, no matter what it costs us. That's a huge promise. And a promise like that only works if the economy behind it actually supports the number. By 1992, Britain's economy did not support it. Interest rates were too high. The country was heading into a recession, and the pound was priced like Britain's economy was strong, when it clearly wasn't anymore. Anyone paying close attention could see that gap. George Soros was paying very close attention. Months earlier, he had already built a bet against the pound worth about $1.5 billion through his quantum fund, betting the currency would eventually crack. Then, on the night of September 15th, the head of Germany's central bank said one loose sentence to a journalist. He said, one or two currencies might come under pressure even after recent changes. He never said the word pound. He didn't need to. Every trader in Europe understood exactly what he meant, instantly. The next morning, Soros didn't wait around. He took that $1.5 billion bet and pushed it to $10 billion almost overnight. $10 billion, betting the Bank of England physically could not defend the price it had promised. Other hedge funds saw what he was doing and jumped in right behind him. Now, half the financial world was betting against the pound at the exact moment the Bank of England was legally required to defend it. So the bank fought back. At 10:30 that morning, interest rates jumped from 10% to 12%, trying to make holding pounds more attractive than selling them. It didn't work. The selling kept going. By 2:15 that afternoon, in a moment of real panic, they raised rates again, this time to 15%, an emergency move meant to prove they were serious. The market's answer was simple. Nobody believed them. The selling got worse. At the same time, the bank was buying pounds directly off the market, trying to soak up all the selling. At the peak, they were buying almost £2 billion an hour. Every single purchase came in at a worse price than the one before it. They weren't stopping anything. They were pouring money into a fire that kept getting bigger. By early evening, the UK government made the call nobody wanted to make. They pulled the pound out of the ERM completely and let it float freely. The moment that happened, the pound dropped 15% against the German mark and 25% against the US dollar. Live, in real time, in front of the entire financial world. The system built to guarantee stability had just failed, publicly, in one afternoon. The real cost of that day stayed hidden for over a decade. Early estimates guessed the damage at up to £27 billion. 13 years later, the UK Treasury finally confirmed the real number, £3.3 billion, gone in a single day. Soros walked away with roughly $1 billion in profit from one trade in one day. Here's the part that matters most. Soros didn't hack anything. He didn't break any laws. He didn't have information nobody else could see. He was looking at the exact same interest rate numbers, the exact same recession data, the exact same quote from a German banker that every other trader in Europe could read. The only difference between him and everyone else watching from the sidelines is he was willing to act on it, at a size almost nobody else was willing to risk. And that's really the whole lesson in this story. A government can promise to defend a price. It can raise interest rates twice in one single afternoon. It can spend £2 billion an hour trying to prove it's serious. But if the real economy underneath that promise doesn't match the number, the market eventually stops believing it. And when that happens, it happens fast, and it happens in public for everyone to see. Black Wednesday didn't happen because George Soros could predict the future. It happened because a government tried to defend a price the market had already stopped believing in. Soros was simply the one person paying close enough attention with enough nerve to bet everything against it at exactly the right moment.